we've Trump and Dissent, they're lowering rates to 1%. They got Moran on the Fed. They're doing the Mar-a-Lago Accord. They're gonna devalue the dollar. Anyone with a brain can't own treasuries. So we're looking at yield curve control. We're looking at QE. No one's gonna be buying treasuries. It's all gonna be coming for gold. Like, they're busting it wide open, and we're seeing gold trade on true supply-demand economics in the first time in 50 years.
Garrett Goggin, financial analyst as well as founder of the Golden Portfolio. It's a true pleasure to host you on Palisades Gold Radio today.
Hey Stijn, thank you. Very happy to be here.
Really excited for our chat today, Garrett. Of course, our first chat ever, and what a time to have a chat today. Gold futures are trading above $3,800 an ounce as we speak currently. Really excited. Would love to dive into that in just a second. But before that, I would love to dive into you, really what your background is and how you got started in precious metals.
Yeah, I've been in the industry for close to 20 years. MBA, CFA, CMT from Boston, traditional mutual fund industry. But, I was always gravitated towards the precious metal sector, just because, the U.S. with all the debt and the dollar going down, how long can this continue? I worked with John Duty, a gold stock analyst, for 15 years, and then we worked with Stansberry Research, and then I had an opportunity to go out on my own and start the Golden Portfolio, and I started it 2 years ago, and so far so good.
Excellent, and really excited to dive into some of the things that you're looking for criteria-wise to invest in a mining company. But before we talk about all that, let's talk about gold for a second. It's currently trading above $3,800 an ounce. Of course, if you look at it a bit longer-term perspective, since 2022, it's up almost double. Is a generalist investor now getting into precious metals too late?
Yeah, it's wild. It's wild what's going on right now. If you look at gold on every technical metric, it's overbought, right? 200-day moving average, 3-year moving average, like it's a peak, it's a peak, it's a peak, it's a peak. So based on that, it's looking like it's richly priced. And then, inflation adjusted 1980 gold, it's higher than that. But the deal is, you got to look at the fundamentals, because in 1980, the U.S. had about $600 billion of debt. Now we got $37 trillion of debt. And then also, there's major fundamental forces in play right now that we've never seen in 50 years. The U.S. weaponized the dollar in 2022 against Russia when they basically deleted the U.S. treasuries or reserves. And ever since then, all of our foreign trade partners, they're buying gold, and they're holding it in their own vaults, and they're not buying treasuries. This great chart that what Tavi did of Crescat, it shows our foreign trade partners, central banks, they own more gold as a percentage of their assets than treasuries. This is epic global, financial shift time. And it's not necessarily, one country having a trouble with, debt and inflation. This is like the global fiat standard of the US dollar. This time's different. And then, we've Trump and Dissent, they're lowering rates to 1%. They got Moran on the Fed. They're doing the Mar-a-Lago Accord. They're gonna devalue the dollar. Anyone with a brain can't own treasuries. So we're looking at yield curve control. We're looking at QE. No one's gonna be buying treasuries. It's all gonna be coming for gold. Trump and Dissent also, they embrace crypto, right? And I just wrote a big thing about that. I think crypto is gold's Trojan horse, because, they talk about Bitcoin being digital gold. It's not. What's digital gold is, Tether gold, like crypto attached to gold. And Tether, they're buying 2 tons of gold per week right now, right? That's 100 tons per year. That's like as big as China. So as U.S. banks, like I'm in the U.S. and you get Chase and Bank of America, and with the U.S. embracing crypto, it's not going to be long before I have my checking account on my app, right? And then I'm going to have a Tether dollar or Tether gold. You'll be able to swap them seamlessly, frictionlessly. Tether's holding the gold in their own vault in Switzerland. It's not a, LBMA, it's not a COMEX, it's not a GLD. They're busting it wide open, and we're seeing gold trade on true supply-demand economics in the first time in 50 years. So that's why I'm willing to go out there and this time say, this time's different. One other thing too is, I'm fundamental analyst, CFA. I build economic models, I build resource models. I try to find, the true intrinsic value of these equities. And some of them, the smaller developers have done really well. They're up 300%, 400%, 500%. But you know what? They're as cheap now as they were a year ago, because the rise in price of gold is driving so much value into their underlying projects that the stock prices aren't keeping up. And then when we reach like a certain peak, we're going to get to a point where, market cap rises closer to NAV value. And we're not there yet. It's a measure of investor sentiment. I track asset flows. I track ETF asset flows, right? Because, ETF, a dollar comes in, you need to create a share, dollar comes out. You need to destroy shares. So I measure shares outstanding to measure investor sentiment. Right now, the GLD, shares outstanding, it's like 30% less than it was in 2011. The GDX, shares outstanding, is at the lowest it's been in 10 years. Like, there's no money coming into the sector. It's only old holders taking gains that's driving the share count lower. Gold's going to continue higher until the masses come, and the masses aren't here yet.
The masses aren't here yet. I would love that. So many threads to pull there. Let's start with quantitative easing, QE, for a second. Perhaps you can explain really, if the Federal Reserve were to take the interest rates to 1%, what that would do to financial markets and how that would ripple through into gold eventually.
Yeah, well, there's been so much going on with the Fed. Kruger stepped down, and then Trump appointed Stephen Moran, the editor of the Mar-a-Lago Accord. The Mar-a-Lago Accord calls for a lower dollar, 1% rates, and we're getting there. And then the most recent lady that had trouble with her mortgage statements, I don't exactly know where that's at. But eventually Trump's going to get full control of the Fed. And then Trump tweeted something on True Social over the weekend about firing, Jerome Powell. Like, you're fired, gonzo. Like, I'm calling it the Treasury. Right? The Fed and the Treasury together. Like, the Fed is losing its independence. Like, they're getting blamed for everything, and it's not their fault. And the Fed and the Treasury are getting together. They're going to have tremendous power. Basent is already doing QE. They're buying back $2 billion of long-end debt, like, per week. Like, if you're watching the Treasury auctions, it's already happening. And then, Trump's a businessman, right? He looks at profit and loss. He wants everyone to be a millionaire. And you know what? Based off the stuff they're doing, yeah, everyone's going to be a millionaire on paper, but a bottle of Coke's going to cost $20 because they're devaluing the dollar tremendously, and all the handwriting's on the wall. Yield curve control, they're going to have to manage the long end lower. They're going to have to manage the short end lower, because inflation is obviously still an issue. Rates should not be at 1%. They should not lower rates to 1%, but they're going to, because it's going to provide like a massive boost in economic activity. And then QE, $37 trillion of debt. Like, there's no way out. There's no one buying it anymore. The only major holder of U.S. Treasury debt that's increased substantially over the past year is the Cayman Islands, which is a quasi-government hedge fund with the Carlyle Group and stuff like that, managing Bush and Bin Laden money. A lot of the other major holders, China's not buying anymore, India's not buying anymore, Brazil's not buying anymore. All the BRICS nations, and then you start throwing in crypto as an alternative payment system, and like, it's happening. The handwriting's on the wall. So, gold, looking at it here, as just straight at price, like, yeah, it's expensive, but you start throwing in $37 trillion of debt, you start throwing in all of our foreign trade partners are buying gold instead of treasuries, you start throwing in the average investor has like less than 1% of their assets invested in gold. And then another study I do, the GLD market cap rises to like 1% of the S&P's market cap at the peak in 2011. We're at 20 basis points right now. Like, we're not there yet. So, I'm hanging on for the ride, and it's going to be a wild ride.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. That's something that always strikes me when I look back into history, how long these gold bull markets can be. And like you outlined, the masses ain't here just yet. And perhaps you can outline, if you look at those historical parallels, when normally in a gold bull market, retail demand or generalist investor demand really starts to kick in, and what type of impact that could have on the gold price going forward.
The earlier this year, I came out with a big thing. I shouted to the world. I got Newmont is 50% undervalued. I follow the money. I follow free cash flow. I follow profits. Based off Newmont's free cash flow, they were 50% undervalued at the beginning of the year. And, all the majors are doing great right now. Newmont was like the number one stock in the S&P 500 right now. But so I monitor this stuff on a daily basis. I take their, estimated production and all-in sustaining costs, and I measure it against the current gold price on a daily basis, right? So I measure EV versus, free cash that's going to be generated. And right now, the miners are only 5% overvalued based off their free cash. They were 25-30% undervalued at the beginning of the year. Now they're about 5% overvalued. And then there are times at the 2011 peak, they traded at a 60% premium to their free cash value. That's what we're not seeing yet. And that's what we're going to start getting into, where the miners start receiving higher valuations based off the free cash flow that they're generating. The average institutional investor, they hate gold, but they're going to be drawn kicking and screaming into the gold market because you get the Buffett indicator, right? The Buffett indicator shows that traditional assets are overvalued, and it's the secular shift between overpriced growth and underpriced real assets, including gold miners. So they're going to be coming for the sector. They have to get involved because they're trailing their benchmarks, because a lot of gold stocks are leading the indices. And that's going to push the gold stocks above their, fair market value. It's a regression. It's a regression over the past, 25 years. I wish I had more data all the way back to 1970. I tracked that with gold and silver. But I just try to buy a dollar's worth of value for 10 cents. Do you know what I mean? And I'm still finding opportunities out there. A miner is worth the most at first production. That's the horrible truth about investing in mining equities is, you don't get the growth. As the miner starts production, they start mining ore, their reserves become depleted, and the NAV value, the total free cash flow, shrinks as every year the mine's in operation. So the maximum share price would be at first production. I have developers that are worth $3 billion that are trading at $400 million market cap, and they should be equal to each other and the beginning production like next year, like in 2026, in a few months. I'm surprised an outsider hasn't come in and taken down some of these smaller gold developers, because the IRR is like 80%. You get 80% return on your money every single year. It's wild, the things I'm seeing.
Really excited to start talking about what you're looking for in the miner space in just a second. Before that, I would love to take you to the Freeport's Grasberg gold copper mine that recently had a tragic slippage. You wrote about this, I believe, in your newsletter.
Yeah, Grasberg. These copper gold deposits are, some of the largest gold producers in the world, and the gold's the kicker, and they're extremely economic. Grasberg is in Papua New Guinea, and it's the mine that built Freeport. They had a big open pit, and then they start going developing underground, and they got big block caves. Block caves are like, huge football-sized, chunks of earth that they're moving out. So, they had a huge cave underground, underneath the open pit, and there was a lot of rain, and all of a sudden there was a mud flow, and the mud flow all flew into the block cave. And I don't know, it's a major issue, and it has implications off of gold supply and copper supply. You get copper that's starting to rip too at whatever $4.50, and there's a couple mines coming on every year or so, but there hasn't been major investment in the commodity sector for years. Everyone wants their Teslas and iPhones, and they think the metals come from magic. It's yeah.
Yeah, like you outlined, this is one of the largest gold copper mines on Earth, so the impact of this slippage, of this slowdown in production, could be huge for both copper and gold.
Yeah, it definitely could. And then, to get this mine back in full production, like they gotta fix it. It's gonna take a while. It might take a year or more. And when these mines go in and out of production, you're not just flipping a switch and turning it on one day. It's like you get, like, say, Cobre Panama with Franco. To get that thing back in production, you need the government to, fully agree what you're getting close to, and then decide you're going to turn it on, and then maybe 3, 4, 5 years down the road, the production will start. But the commodities sector is it's been undersupplied for decades. There hasn't been any major capital investment. The major gold companies, they've been paring their portfolios since 2011, right? They haven't committed any capital. There's basically not many major capex gold projects or copper projects, coming online right now.
Perfect. I would love to take you to the gold miners for a second. Is there still value to be found in the really large, high-quality gold miners, like, for example, the Agnico Eagles of the world?
Yeah, Agnico's done the best. Why has Agnico done the best? Because the only thing that moves the share price higher is increasing earnings on a per share basis, increasing profits, free cash flow, earnings. You need to do it on a per share basis. Agnico has been very successful in doing this because they do a lot of option agreements where they're paying 10 mil, 20 mil to get involved with a smaller explorer, and if it proves out, they'll eventually take the explorer over. They'll build the project for a couple hundred mil. They love grade. Grade's the only thing in mining that moves the profit needle, because mining on a per tonnage basis is relatively fixed cost. So the only way to boost your profits is through grade. So Agnico, if you look at the money that they pay for acquisitions, which is, say, whatever, 200 mil, they spend another 300 mil building a mine, they're generating significant amounts of free cash flow from that asset, like way more than, say, the 500 mil that they're already in. And that's why they've done such a good job driving earnings on a per share basis. The average miner, like, we're seeing it today. Tom Palmer just left Newmont. Mark Bristow just stepped down from Barrick. Both these guys, like today, just got announced an hour ago, are leaving their positions. The problem with the average big cap miner, it's too political and it's too bureaucratic, and they're not going to do anything until it's 100% politically acceptable and everyone, votes on it and it checks all the boxes. But by that time, that asset's going to cost 10 times more. Do you know what I mean? Like Bristow made Randgold. Randgold was the original Agnico. It was generating significant profits per share, driving the share price higher. And the way he did that, one of the major reasons is Kibali in the DRC. And Kibali's like a no-go for any major miner. Like, we can't do it. We're not going to do it, although it's changing now. He bought Kibali for a couple hundred mil, and he's generating, like, they did 750,000 ounces of gold production last year. Like, you need to look at what they pay for assets versus what they get back. And all the major miners, and they're like, oh, we need to go to politically safe jurisdictions in Canada, the US, and all this stuff. Yeah, you're overpaying 10x on that, and you're never going to make any money. So management gets paid, bankers get rich, and shareholders don't make anything because the earnings per share never increases.
All right, thank you for that overview. And I would love to talk about a second, really, what you are currently looking for and what opportunities you're finding. So walk through your criteria. First, perhaps from a high-level overview, really, what is a good value proposition or a good bargain for you?
What's a good bargain? I'm blown away, honestly, blown away, because Some of the developers that are going to be in production next year or the year after, they're up 500, 600%. And then, if you're just looking at squiggly lines on a chart, you're like, oh God, it's up so high, how can I buy it? But yeah, it's trading even at a larger discount to NAV now than it was a year ago, even after the stock price has run up 500%. And then I went to Beaver Creek Precious Metals Summit and I met with, 40, 50 different of my favorite companies. And you should see the value that they're generating. Like one of them, it's in West Africa. It had a NAV value of like $3 billion. And its production profile was like 230 ounces for 4 years, and it dropped down to like 120,000 ounces. They're filling that all out through satellite pits with higher grades. Like you're filling in the whole 20 years. NAV value is going from 3 bill to 6 bill. And the stock is like the discount and the value that they're generating right here is staggering. Another one, I think it's worth like 2.5 bill. Starter open pit, 20,000 tons per day. They got water issues. They just announced the other day that they're doing a water feasibility with Kinross, and it's going to allow the mine to scale to 80,000 tons per day. That's like a $5 billion NAV. The stock is trading at 400 mil, and it's going to be in production by the end of this year. It's free money on the table. The discounts show to me that investors are not in the sector yet, which gives me confidence that we have longer to go in this gold price grind higher.
If I try to pull a trend from these multiple stories that you've just outlined, these opportunities that you're finding, you are finding these assets that are distressed in one way or the other. The market's a bit overreacting to that, and you believe all these problems are solvable. Is that really the area where opportunity can be found currently?
Yeah, I don't know about distressed assets. A lot of the companies, I try to find the cream of the crop, the best mining projects in the world. And I think my portfolio, my GPIV portfolio, it's up 500% in less than 2 years. There's nothing else like it. And it's the best gold development projects in the world today. And they're still massively, massively undervalued. There's no money in that in the sector yet. And the generalists will come in, they'll start buying, the majors, Agnico and Newmont and Barrick and stuff like this. But, we're going to continue going until the developers start and the explorers start closing the gap to true NAV value. And like I said, the majors, they've been paring back their balance sheets for years, and they're still doing it. They're still casting away assets. We haven't even turned the tide to start growing production yet. You know what I mean? Like the last cycle, the peak was when Ty Burritt, the CEO of Kinross, paid $7 billion for Redback and Tasiast. That was a disaster for 15 years, but they finally got it turned around, and now it's working great for them. But we're the exact opposite end of these bidding wars for these great development projects by the majors, and that's another measure of sentiment that shows the valuation in this sector.
Talking about business model for a second, it sounds like you're quite agnostic towards that. You're looking at producers, developers, explorers. You're willing to go everywhere on the Lassonde curve as long as there's value to be had.
I try to. I find value in the trough of the Lassonde curve. Exploration, right? I love high grade drill holes. I follow grade, and then once you have one, wide width, high grade drill hole, the chances are there's probably going to be more once you start drilling around it. And then the second one is, after they get, as their financing and the stock price drops and they start building out the first production, it's basically almost like time value arbitrage, because your NAV model includes time. Each year is another 5% discount. So as you start narrowing the time window, the equity value starts going up. And if you're confident in these projects, and like I am in the ones that I own because I know them, you're just waiting for time to pass and value is going to be created. And when they reach production, it's going to be fully de-risked. They're going to start trading at a multiple. The average is 7.5x for a gold miner. And as they're building out, they're trading at a projected 2x or 3x. So nothing needs to happen. All you need is time to pass, and they're re-rated higher. But the main reason why I started the golden portfolio is because, my golden portfolio product, it's the royalties. I've been in the sector for 15 years, cover the royalties. kept seeing all the acquisitions occur, all the big fish eat the small fish again and again and again. And then, if you look at the average miner versus the gold price, the majority of them have underperformed the gold price up until now, the past couple months. Now we're starting to rip. The only one that did was Agnico. But if you look at the royalties, all the royalties outperform gold. Why? Because their costs are fixed, right? When inflation pushes gold higher, pushes mining costs higher, so miners remain constrained. They have limited management. You can run these things with like 5 people. You get free exploration upside. Their deals are priced at, the analyst expectations of the gold price at 2,600 when gold's at 3,500. They're immediately benefiting 20-30% right up top. And then, the ongoing sector, the ongoing consolidation within the sector. I built a model. I'm like, all right, here's my royalty portfolio. How you've done, a back-tested model holding all the royalties. You're like 15,000% over the past since 2007. It's like better than Buffett. It's better. It's 30% a year. One of my favorite miners, Origin, was bought out earlier this year because of their 1% SR in Silicon Merlin. Silicon Merlin's owned by Anglo Monster Gold Project. High grades in Nevada, and I shouted it from the rooftops. I'm like, this one's going to get acquired, and it did. And then Sandstorm got bought out this year, and one other one did. But it's an ongoing consolidation. So that is like a steady state, conservative portfolio, like just buy the royalties, forget about it, walk away. Versus, the miners, the developers, the explorers and miners, you got to time them better, right? You got to find the peaks and troughs in the cycle.
So to understand the risk curve, really, you see these royalty companies as the lowest risk opportunities, really a true value investment. You buy them for the right price, you forget about them, and they will just churn out cash flows over time.
Exactly. And then when the gold price goes down, the miners' costs have gone up. And the gold price starts going down, so the miners' margins get crushed, whereas the royalties margins are 98%, So even though gold will go down 10%, their margins are still 97%. There's a guy, Paul Singer, he runs Elliott Capital in New York City. They manage billions of dollars. He's a traditional investor. He's a gold bug though, but he needs to keep everyone happy. So he knows royalties are the best way to invest in gold, to play gold. So he started Triple Flag, right, with Sean Usman, the Barrick Gold CFO. And Triple Flag is like 40% of his portfolio now. He's a very smart dude. He knows royalties are the best way to play it. So, royalties, they might lag a little bit on the upside here, but on the downside, they hold up much better than the miners.
Talk to me about management for a second. How important is that in your analysis of these companies and the confidence to really own them long term?
Yeah, it's a small industry, in Toronto and Vancouver, and I go to all the shows, and I've been doing it for a long time. I have a lot of friends in the industry, and, there's guys I'd give my money to, you know what I mean? And there's guys I would never give my money to. There's good guys and bad guys in this sector, and it's easy to kick back and create a lifestyle company. It's not easy. It's hard because you constantly having to sell shares. But there's value creators in the industry like Eric Fear of Silvercrest Mining. I was all over that when First Majestic bought it. They spent out Silvercrest Metals that got acquired by Core. That guy's a value creator, build stuff on time, on budget. He's interested in creating shareholder value, not making himself rich. He's a significant shareholder and, offers opportunities. So, I follow the value creators, in the industry, and I try to stay away from the value destroyers. And one of the ways that if I don't know much about the company, I usually know the people involved. I know who's behind them. I have a Bloomberg and I'm able to take a look at shares outstanding, right? And shares outstanding, when I start seeing it, go up 5x or 10x over 2 years, and I look back, I'm like, what value have they created? And I don't see any. That is a straight up, avoid pass for me. They need to be raising whatever 5 mil and drilling and generate value from that drilling. Just the constant dilution is the cancer of the mining industry, and I avoid it at all costs.
Well put. Talking about price for a second, multiple ways to look at a good price, a bargain in a company, in a stock. I understand you're really looking at these cash flows, or at least a discount to the intrinsic value a company should have. What is more important for you, having a good margin of safety and therefore decreasing your risk, or is it all about upside potential and spreading risk through diversification, for example?
I lean to upside versus safety because upside means to me you're paying less money for an asset, and that brings me into riskier regions. But like I said, I follow the money, and if the profits are there, like it's gonna get built. One of the companies that I've liked, it's in the DRC. It's a Kabali lookalike. They've got 3 million ounces of gold. It's soon to be 5 million ounces of gold. It's been ignored, underexposed for years here. But now, because of all the mineral deposits in the DRC, Trump's involved. The DRC government is working with the U.S. You get Bezos and you get Elon Musk going in. They're backing cobalt, I think, which is cobalt because they need it for the batteries. And the deposits are there, the money's there, the security will follow. So that's where I really find the value. And then, a lot of the projects in Canada and the US, you pay a premium for that. And like I said, for me, it's all about, market cap versus NAV value. And if I could see a significant gap between the two, I'm willing to get behind it. But then there's also a lot of intangible things too, like what's the true probability that this project will be developed based off the management, based off where it is, based off that. That's softer stuff because there's projects, in Alaska, that are, on a river, beautiful river with fish, and it's right near the ocean. Like, it'll never get built. So I don't care what sort of discount it's trading at. Like, it's never going to get built. The project has to have merits, and it has to, have the probability of being built for me to get involved.
Excellent. Well, that really takes care of the question on jurisdiction. You seem to be quite agnostic towards that as long as the value is to be had. I would love to talk about portfolio allocation for a second, really how you could go through that process. How do you, from a high-level overview, manage your portfolio?
I've got my golden portfolio royalties. I've got my 10X, which are developers and explorers and undervalued miners. And then my introductory product is the GPIV. What I say is equal weight your portfolio across all your holdings and let the market figure it out for you. Because what happens, my 10X has got 30 companies in it. You're putting 3% in each holding. And then what happens is some of these companies do great. They go up 300%, 400%, 500%. And that 3% will rise to 6% to 9% to 12% of your portfolio, even higher to 20% of your portfolio. And with investing, 90% of your investment gains come from 5% of your portfolio, right? So you need to hang on to your winners and you need to cut your losers. Like when the stocks are underperforming, they're not doing well, like don't believe the hype and keep pouring money into your losers because they're cheaper. You need to stick with your winners. The winners, prove out. And, the world-class projects, like I'm blown away by the performance and I'm blown away by the value that they still offer here. Like stick with your winners.
Stick with your winners, of course. On the flip side, no one has ever lost money by taking a profit. So really, how do you balance that? And how should you think about taking profits in the mining space where you can have these runners that do 10x, 20x returns if you pick the right companies over time?
Yeah, the best way to do it as far as an individual investor, you need to be diversified, right? You got to have, you got your gold stocks. That's 10%, 20%, or 100% in some cases, right? But you need to own tech, you need to own healthcare, you need to own, industrials, you need to own, consumer staples. So, your gold stocks make up whatever 20% of your equity portfolio. And then when your gold stock equity portfolio starts rising at 25, 30%, start taking gains on it and start investing in the sectors that have not been doing as well, because it'll be like a cyclical shift, right? That'll rebalance it. So that's the easiest way to do it. And then you're purely going by math, not emotions or feelings or anything like that. But, I was writing stuff today about the gold market, where we're at. And, if you could time it perfectly, like I'd be a billionaire, and I wouldn't be writing a newsletter. But it's extremely hard to do. But I am pretty confident in tracking these asset flows. So there is going to be a time in the future, and we're not there yet, where it will be time to say, hey, we might want to lighten up as a whole across the entire portfolio, where market cap starts rising closer to NAV value, and a lot of the value is not there anymore. But we're not there yet, and we have a ways to go, because like it's a secular shift. One of the things that's interesting to me right here is silver, right? I run a regression, gold versus silver, since 1970, and silver is still trading at this like 6% discount based off the gold price right now. And silver is starting to bump up close to $50 an ounce, but versus gold, it's still undervalued. And then we've had major blow-offs in silver, right? Where like within a week or two, it ramps, goes bang, 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 goes up, almost doubles. That happened in 1980 and 2011, and we're starting to see similar action here. But that next big blow-off is going to be a signal to me, because gold markets have a roof of silver. That silver blow-off marked the peak in the gold price as well in 1980, and it marked the peak in 2011 as well. So I'm like cautiously optimistic. I see silver breaking out, and I believe it's gonna have a major ramp here. So I'm like looking forward to it, but I'm also dreading it a little bit, because gold bull markets have a roof of silver, and that's when the speculative frenzy really hits. You get a lot of these silver miners that haven't moved at all in like 10 years or 20 years that will go up 5x, 6x, 10x. But the thing that's hard about silver is these massive blow off tops. They only last like days. They only last like a week or so. So you need to time it perfectly. And I'm watching it closely every day, and staying involved. I just reweighted my 10x portfolio more highly to silver, like 25% or 22% versus 78% in the gold stocks. So yeah, I'm looking forward to this, silver, explosion to the upside. That is basically what I see is inevitable. And then a lot of these guys, regarding portfolio management, they invest for these blow off tops that happen once every 20 years, 50 years. Like I like to see them because it drives value, but it also drives a lot of speculative frenzy. I'd rather invest for the 99% of the time, you know what I mean? Versus that 1% big blow off. I'd rather invest in that miner that can generate value regardless of the gold price, through finding higher grade resources, through improving their mining, making a smaller starter open pit, and doing development underground, and lowering the strip ratio, and driving value that way. I just look at gold and silver price as the cherry on top of a proven successful value creating operation underneath.
That takes care of the question regarding silver. Appreciate that. That blow off top that you're describing at the 1980s and 2011, of course. So that's something that you're looking forward to. Is that any different now that we have significantly more industrial demand for silver? So we have more of a stable demand behind the scenes rather than just this investor demand peaking.
Yeah, the silver is an industrial asset. Each solar panel uses a third of a gram. To manufacture a solar panel, you get it used in batteries and stuff like this. So yeah, it always has the industrial demand, but you know what? It's been this way for a long time. It's been this way for 10 years, 20 years. Yeah, the industrial demand is picking up. The Silver Institute, silver's been in a supply deficit of over 100 million ounces for at least 5 years here. But I see the higher price of gold, and that's driving the train. That gold trading on true supply and demand fundamentals for the first time in 50 years is unlocking silver. So I see that more important, and I can't see silver going up without gold, right? As gold continues higher, silver will continue higher. If gold tops out and starts trading down, I can't see silver, even no matter how big the industrial demand is, hanging in there. So I'm watching sentiment, I'm watching asset flows, I'm watching, gold, silver price performance, in order to ascertain relative value and when, like, this next selling point is upon us. And like I said, we're not there yet.
We're not there yet, all right. Talking other precious metals, for example, platinum and palladium, are those on your radar as well?
Not really, because there aren't many miners, that produce them. You get Sibanye that does, platinum. I think palladium, the 3Ps, but Sibanye's struggle, and there's only a few miners that cover the industry. The gold and silver sector, there's a lot more companies involved, and it's more interesting. You're always able to find good tidbits and good stories, and so I tend to focus on the gold and silver.
Excellent. Perhaps you can talk to us shortly about the golden portfolio.
Yeah, golden portfolio started 2 years ago. The golden portfolio GP is my royalty portfolio. That thing's like 30% a year. It's up over 100% this year. It's done great. My 10X, again, has done great. It's smaller explorers and developers in the trough of the Lassonde curve, and the values being played out. And like I said, a lot of the companies have done great, but I can't believe that they're still only trading at 20%, 30% of NAV. And then, my introductory product, my GPIV, contains 4 or 5 of my top picks. And that thing's up 500% in 2 years. This is audited performance. These are real portfolios. This isn't like a stock of the month club. A lot of newsletter guys, they get paid by companies. They'll recommend this, they'll recommend that. And then at the end of the year, they only talk about the winners. I don't get paid by anyone other than my subscribers. And I've audited performance. I'm a CFA, I'm an MBA from Boston, and I build real portfolio. This is a real portfolio, and it's done great. And it's got a ways to go.
Garrett, thank you so much for your generosity with your time and your insights today. Really appreciate it.
Awesome. Thank you for having me.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR Plus at www.sedarplus.ca.